Welcome back to the Deep Dive. As you know, we've previously taken a good look at Dialog Group, specifically their long-term strategies and, of course, that notable first loss they reported in 25 years.
That's right.
If you want a refresher, those deep dives were titled Dialog Group's Latest Results, First Loss in 25 Years, and Deep Dive into Dialog Group, Navigating Challenges and Seizing Opportunities. Today, we're picking up where we left off, turning our attention to their performance in the third quarter of their financial year 2025.
Exactly. Consider this our next step in understanding Dialog's journey. Our mission today is really to get under the skin of their latest interim financial report for Q3 FY2025.
Okay.
Layer in the insights from a Kananga research report that's from May 16th, 2025, scan relevant news from around then, and, connect it all back to our previous discussions.
Right.
We're keeping a firm investor focus here. What do these latest developments tell you about a Dialog's current standing and future potential?
Okay, let's unpack this then. Starting with the headline numbers for Q3 2025. Revenue came in at RM 578.8 million.
Yeah.
Which, on the face of it, is a significant 17.6% drop compared to Q3 FY 2024. That's a sizable chunk.
It is, definitely. And drilling down to the bottom line, net profit after tax was RM 134.8 million, also down by 16.1% year-on-year.
Right.
However, and this is a really important point for you to note, this represents a substantial recovery from the previous quarter, Q2 FY 2025.
Ah, okay.
Remember, they actually reported a net loss then of RM 125.6 million. So while we're still looking at a year-over-year decline, the momentum has clearly shifted upwards in this latest quarter.
That recovery does feel like the key story for this period. But to get a broader perspective, the overall trend, if we look at the 9 months ended March 31st, 2025.
Yeah, that gives the fuller picture.
This picture becomes a bit more complete. Revenue for that longer period is RM 1,893.3 million, which is a significant 19.2% lower than the same period last year.
Right.
And the net profit after tax for those 9 months, it stands at RM 157.9 million. That's a considerable 65.7% decrease year over year.
Wow. Yeah.
That really highlights the impact of that Q2 loss
Yeah.
and the broader challenges they've been navigating, doesn't it?
It does. The scale of that year-on-year decline really emphasizes the context for this Q3 recovery.
Okay.
And we see a similar trend in the basic earnings per ordinary share. For Q3 2025, it was 2.39 sen, down from 2.77 sen in Q3 2024.
Right.
And looking at the 9-month figure, it's 2.77 sen, a sharp drop from the 7.74 sen recorded in the corresponding period last year.
So some definite headwinds in those headline figures. Let's delve into the engine room of the business, see how the different segments are performing.
Good idea.
What were the key drivers behind these numbers, particularly that Q3 recovery?
Well, what's particularly interesting here is the divergence in performance across Dialog's business segments.
Yeah.
Within Malaysia, we're seeing a stronger showing, driven primarily by their midstream and upstream operations. The midstream segment that's centered on their tank storage facilities reported improved earnings, thanks to both higher occupancy rates and an increase in tariff rates. Their upstream business also delivered solid results with strong production volumes.
It's encouraging to hear that core parts of their operations are performing well. You mentioned a slight headwind for the upstream segment, though.
Yes, just a slight one. While the production volumes were robust, the fact that realized oil prices were lower compared to the same period last year, well, it did slightly dampen the revenue and profit contribution from the upstream segment.
Got it.
Now, when we look at their international operations, we see a different picture. Revenue and profits from these ventures were lower,
Why was that?
largely due to reduced business activities. And this is directly linked to the pending divestment of their 60% stake in the Dialog Jubail supply-based DJSB in Saudi Arabia.
Ah, yes.
The agreement for that sale was reached back in August 2024. So that strategic move is already being reflected in these numbers.
Ah, okay. That divestment is clearly having an impact on the international side then. What about the EPCC division? That's been a focus in our previous discussions, especially those cost overruns. How did that fare this quarter?
Right, this is where we see a significant positive shift. The EPCC division actually achieved break-even in Q3 2025.
Break even, that's big.
It is. A notable improvement considering the cost overruns we've discussed before. Kananga research specifically pointed to this as an encouraging early sign that this segment is, beginning to stabilize.
Right.
For you as an investor, sustained break-even and then hopefully profitability in the EPCC division would be a key indicator of a turnaround.
Break even is definitely a step in the right direction. Let's switch our attention now to the overall financial health of the company. What are some key takeaways from their financial position? This is as of March 31st, 2025.
Certainly. From a liquidity perspective, Dialog holds a healthy balance of cash and cash equivalents. It amounts to RM 500.4 million before any pledged amounts.
Okay, healthy cash.
Their total bank borrowings stand at RM 1,085.9 million. And it's interesting to note a trend towards a higher proportion of short-term borrowings within that total. This is something investors might want to keep an eye on in future reports, to understand the rationale and potential implications.
A shift towards short-term borrowing.
Yeah.
Could that signal anything specific to you, or is it too early to say?
It's a detail that warrants monitoring. While their overall debt-to-equity ratio remains at approximately 0.4, which is generally considered conservative.
Yeah, it's pretty low.
Right. But a greater reliance on short-term debt could introduce more refinancing risk if interest rates were to rise significantly.
Makes sense.
Their total assets have seen a slight decrease, down to RM 8,640.2 million from RM 9,130.3 billion at the end of June 2024.
Okay.
Similarly, total equity attributable to the owners has also slightly decreased to RM 5,711.7 million from RM 5,944.2 million.
These minor contractions
Yeah.
may be linked to the divestment cost management.
Could be both, yeah. It suggests a slightly leaner balance sheet overall, but still, as you noted, a manageable level of debt.
Okay. Now, dividends. Always on the radar for investors. What's the latest news on that front?
Right. Dialog has declared an interim dividend of 1.30 sen per ordinary share for the financial year 2025.
Okay, 1.30 sen.
It's important to note for comparison that the interim dividend for the previous corresponding period was 1.50 sen.
So a slight reduction.
Yes. The entitlement date for this interim dividend is June 12, 2025, and the payment is scheduled for June 26, 2025.
Good dates to note.
And just for completeness, the final dividend for FY 2024, which amounted to 2.80 sen per share, a total of RM 157.995 million that was paid out back on December 20th, 2024.
Okay.
The slight reduction in this interim dividend likely reflects the overall financial performance we've been discussing.
A slightly smaller interim payout this time. Yeah, that's understandable, given the year-to-date figures. Now, you mentioned analyst perspectives earlier, specifically from Kananga Research. What were their key insights and recommendations following this Q3 report?
Yeah, Kananga Research pointed out that Dialog's core profit for the first 9 months of FY25, that's excluding any impairments, actually fell short of their expectations.
Okay, why was that?
The primary reason they cited was the slower than anticipated recovery in the EPCC margins.
Right, the break-even is good, but maybe not recovering profitability as fast as hoped.
Exactly. Consequently, they have revised their FY25F, that's forecasted earnings, downwards by 10%. It reflects a more conservative outlook on how quickly those EPCC margins will improve.
Okay, a 10% cut for this year's forecast.
However, they have maintained their FY26F earnings forecast,
Oh, interesting.
based on the assumption that the significant cost overruns experienced previously are unlikely to be repeated. This suggests they see the recent break-even as a potential turning point, like we discussed.
So a near-term adjustment in expectations, but a longer-term view remains relatively stable.
That's interesting. What's their formal recommendation on the stock, then?
Despite the earnings revision for this year, Kananga is maintaining an outperform rating on Dialog,
Outperform. Okay.
with a sum-of-parts-based target price of RM 1.94.
So REP, right, where you value each bit separately.
Precisely. Midstream, upstream, downstream value each, add them up. Given the trading price of around RM 1.77 at the time of their report, they still see a medium-term upside potential.
Right.
They highlight that the forecasted price-to-earnings ratio for FY26 remains close to one standard deviation below its 5-year average, which they interpret as suggesting the stock could still be undervalued.
Okay, so they see potential upside based on their valuation. What are some of the specific factors that Kananga believes will support Dialog's performance and potentially drive that re-rating?
Well, they anticipate that the tank terminal segment, the core of their midstream business, will continue to demonstrate resilience.
Makes sense. That recurring revenue. Exactly. And interestingly, they believe that the current weaker crude oil price environment with Brent crude having fallen over 20% year-to-date in 2025 can actually lead to increased demand for crude oil storage.
Contango play perhaps,
Yeah.
or just general storage needs.
Could be both, but certainly increased demand benefits Dialog's terminals directly. They also note that the potential upside from Phase 3 of the Pendrang expansion, known as the Camone project, that remains a bit of a wild card.
Right.
It hasn't been factored into their current forecast, so if that project moves forward, it could provide a significant boost.
So resilient core business and potential future growth catalysts. Okay, let's revisit the concept of Dialog's economic moat, something we've discussed in our previous deep dives. Based on this latest information, how would you assess the strength and sustainability of their competitive advantages now?
Yeah, good question. The latest information really reinforces the view that Dialog possesses a, let's call it, a narrow economic moat,
Narrow.
primarily centered around its midstream business assets. Specifically, those strategically located tank terminals in Lingsat and, more importantly, Pengerang.
Right.
These terminals generate a relatively stable and recurring revenue stream through storage fees and tariffs, which, as we've noted, provides a buffer against the inherent volatility of crude oil and gas prices themselves.
So the physical infrastructure
Yeah.
is key to their defensibility, the terminals themselves.
Absolutely. The tank terminal business is characterized by high barriers to entry.
Hmm.
Developing large-scale infrastructure like this requires substantial upfront capital investment, specialized engineering expertise, and navigating complex regulatory approvals. It makes it really difficult for new competitors to easily enter the market.
Right.
Furthermore, Dialog's strategy of expanding capacity in phases, often in close collaboration with long-term customers, can create a degree of stickiness, potential switching costs. And as the second largest independent terminal owner come operator in Southeast Asia, their established scale also provides a significant advantage in terms of operational efficiency and market reach.
That makes sense.
Yeah.
But you still classify it as a narrow moat. What are the limitations here? Could it be broadened over time?
Yeah, narrow because while the midstream business enjoys these strong defensive characteristics, the downstream EPCC business operates in a much more competitive landscape.
Right.
And it's demonstrated its vulnerability to market fluctuations and project-specific challenges, as we saw with the past cost overruns. That segment just doesn't exhibit the same level of durable competitive advantage.
Okay.
Furthermore, the recent impairments in their ventures into specialty chemicals and recycled plastics suggest that their attempts to diversify into new areas haven't yet translated into significant competitive strengths.
Fair point.
Looking ahead, though, their foray into renewable fuel storage within the midstream segment could potentially broaden their moat if they can establish a leading position in this evolving market.
How would we know?
Securing long-term contracts in that space would be a key indicator, I think, that would show real traction and defensibility.
Right. A core strength in terminals, but other areas are more exposed or still developing. Let's shift our focus then to the future. What are Dialog's stated prospects and strategies for growth moving forward, beyond just the next quarter?
Well, their overarching strategy remains focused on long-term growth across their three core segments: upstream, midstream, and downstream.
Okay.
The midstream business is clearly positioned as a central growth engine. There's ongoing investment in phase capacity expansions at the Pengerang Deepwater Terminals, PDT.
Right, Pengerang.
The aim is establishing it as a premier integrated hub in the Asia-Pacific region, and the commencement of the joint venture with Petronas Gas Berhad for an LNG-driven air separation unit within PDT, that's a significant step in enhancing the attractiveness and capabilities of that hub.
And they're also strategically moving into new areas within the midstream space, aren't they? You mentioned renewables.
Precisely. Their venture into renewable fuel storage under Dialog Terminals Langsat 3 is a clear indication of their forward-looking approach. Phase 1 is already operational.
Okay.
And the significant second phase expansion that's for both renewable and petroleum products, with a substantial portion earmarked for Eco-Series Limited, it signals their commitment to capitalizing on the growing demand for sustainable fuel solutions.
So that move could indeed strengthen their midstream moat over the long term.
Potentially, yes. It's a strategic bet on where the market is heading.
That's a significant strategic development. What about their plans for the upstream sector?
In the upstream business, their strategy involves organic growth through the development and rejuvenation of existing oil and gas fields.
Okay.
The commencement of development for the Berhad Junior Cluster Small Field Asset Production Sharing Contract, that's a JV with Petros, and the ongoing pre-development studies for the RJA Cluster Small Fields Asset Production Sharing Contract.
Right.
It demonstrates their commitment to expanding their production capabilities. And this increased upstream activity also creates synergistic opportunities for their downstream engineering and specialist technical services divisions.
So leveraging their existing expertise across different parts of the energy value chain? Smart. What about the downstream EPCC business, though, given its recent volatility? How are they approaching that segment moving forward?
Well, they seem to be adopting a much more selective and cautious approach to bidding for new downstream EPCC contracts.
Makes sense after the overruns.
Exactly. The emphasis now appears to be on prioritizing in-house projects and being highly selective about external bids, probably due to the geopolitical and market uncertainties and, the lessons learned.
Right.
They have also recently completed an expansion of their fabrication facilities in Pendrang through their associate company, Morimatsu Dialog,
Okay.
which will enhance their capabilities in producing specialized process modules for various industries. That could lead to more profitable and controlled project execution down the line.
It sounds like a strategic recalibration then. Focusing on their core strengths, pursuing more measured growth in other areas. What's the management's own assessment of their prospects for the remainder of this financial year, ending June 30th, 2025?
Management has expressed optimism. They expect positive performance for the financial year, provided there are no unforeseen adverse events. Standard disclaimer, but still optimism.
And Kananga Research also highlighted some potential downside risks that investors should be aware of, didn't they?
Yes, they did. Kananga identified a few key risks to consider. These include the possibility of a reversal in the current trend of easing cost pressures.
Inflation rearing its head again.
Potentially. Also, potential delays in their planned capacity expansion projects and the risk of lower than anticipated utilization rates at their tank terminals.
Okay.
These are all factors that could impact their future financial performance. Things for you to watch.
Okay, we've covered a significant amount of ground here. A really detailed look at Dialog's Q3 2025 performance and their current trajectory. Let's now pivot to the central question for many of our listeners. Based on all of this information, from an investor's perspective, would you consider investing in Dialog Group at this point in time?
Right, that's the critical question we've been building towards, synthesizing the information. We see a company that has shown a recovery in its most recent quarter after a period of, significant challenges. While year-on-year performance is still down, the core midstream business provides a relatively stable and recurring income stream, underpinned by that narrow but important economic moat.
Okay.
They are strategically investing in future growth areas like renewable fuel storage and expanding their upstream presence. Their approach to the previously troubled EPCC division appears to be more disciplined now.
In the financials.
They also maintain a healthy cash position and a conservative debt profile. And importantly, we have a reputable analyst maintaining a buy equivalent rating outperform with a potential upside to their target price based on that SOP valuation.
So a picture with both strengths and areas needing continued improvement or at least monitoring. How should our listener weigh these factors when making their own investment decision?
Well, it really hinges on your individual investment objectives, your risk tolerance, and your investment horizon.
Right.
Dialog presents a long-term growth story, particularly within the Asia-Pacific energy infrastructure space. However, the recent volatility in their financial performance needs to be acknowledged.
Can't ignore that Q2 loss in the YTD figures.
Exactly. The analyst target price suggests a potential return, but that is contingent on factors like securing new long-term contracts for their expanding terminal capacity and the successful execution of their strategic initiatives.
And maybe that oil price factor.
Yes, the potential tailwind from increased storage demand due to lower oil prices could also be a significant factor in the near to medium term. So for an investor with a longer-term perspective, someone who believes in the growth of energy infrastructure in the region and is comfortable with some recent earnings volatility, Dialog could be a compelling consideration. However, careful monitoring of their EPCC division's performance and the progress of their expansion projects will be crucial.
So it's about balancing the current headwinds with the underlying strength of the core business and the potential for future growth driven by those strategic investments.
Precisely. You'd be weighing the significance of that Q3 recovery against the broader year-to-date decline. You'd be assessing the durability and potential expansion of their midstream moat. Understanding the drivers behind their shift towards short-term borrowing and monitoring their progress in the renewable energy storage sector would also be important aspects of your due diligence.
Okay. To bring this deep dive to a close, what would you say are the absolute key takeaways from our analysis of Dialog's Q3 2025 performance?
I'd say the core takeaways are, first, the welcome return to profitability in Q3 after a challenging period marked by that significant loss. Second, the fundamental resilience and recurring revenue provided by their midstream tank terminal business, which benefits from high barriers to entry.
Okay.
And third, their strategic positioning for the future through investments in renewable fuel storage and a more focused approach to their upstream and downstream operations in what is undeniably a dynamic energy landscape.
And finally, a thought for you, our listener, to consider. Given this mix of a recovering financial performance, a solid core business, and strategic moves towards future growth, how do you evaluate the balance between the short-term challenges and the long-term potential of Dialog Group?
Yeah, what further information beyond what we've discussed today would be most critical in informing your own investment decision?
As always, we encourage you to dive into the source materials themselves, the financial reports, the analyst notes, and conduct your own thorough due diligence. Thank you for joining us for this in-depth look at Dialog Group.